Marcus was 29, a software engineer in Austin, Texas, pulling in $95,000 a year. He had $38,000 invested, every single dollar in U.S. stocks. His logic? America is the greatest economy in the world. Why look anywhere else? Then his colleague showed him a chart that made him question everything. Today, we're going to look at that exact chart and break down one of the most debated questions in investing. Should you keep your money in domestic stocks, go global, or do both? Let's start with the basics. Domestic investing means putting your money into U.S. companies. Think Apple, Amazon, ExxonMobil. International investing means buying shares of companies based outside the United States. That breaks down into two main buckets. Developed markets, places like Europe, Japan, and Australia, are stable, established economies. Then there are emerging markets, countries like India, Brazil, and China, which are growing faster but carry more risk. Marcus had heard these terms before but never really understood what they meant for his wallet. Now he was about to find out. Here's the chart that stopped Marcus cold. This is the cumulative performance of U.S. stocks versus international developed markets over roughly 2 decades. The U.S., represented by the S&P 500, has dominated, especially since 2010. But look at the early 2000s. International markets actually outperformed the U.S. for nearly a full decade. That's the pattern most investors forget. No single market leads forever. History shows us that performance cycles between regions, and that's exactly why diversification matters. So why has the U.S. crushed international markets since 2010? A few big reasons. First, American tech giants. Companies like Apple, Microsoft, and Nvidia exploded in value and have no real global equivalent. Second, a strong U.S. dollar actually suppressed international returns for American investors. More on that in a moment. Third, U.S. corporate earnings growth simply outpaced the rest of the world. But here's what made Marcus pause. U.S. valuations are now historically stretched. The price-to-earnings ratio of the S&P 500 has been significantly higher than international markets, meaning U.S. stocks may have less room to run. This chart tells a powerful story about value. It shows the cyclically adjusted price-to-earnings ratio, or CAPE ratio, which compares how expensive stocks are relative to long-term earnings. As of 2024, the U.S. CAPE ratio has been hovering around 30 to 35, well above its historical average of about 17. International developed markets sit closer to 15 to 18, emerging markets even lower. Marcus looked at this and thought, if I'm buying U.S. stocks right now, I'm paying a premium. International stocks might offer a better entry point based purely on valuation. Here's something Marcus didn't know. When you invest internationally, you're actually making two bets, one on the foreign stock and one on the currency. If you own European stocks and the euro weakens against the dollar, your returns shrink even if the stocks went up. This is called currency risk, but it works both ways. A weaker dollar can actually boost your international returns. Some funds hedge this risk using financial instruments to lock in exchange rates. Others don't. Marcus learned to check whether an international fund was hedged or unhedged before investing. It matters more than most people think. Here's the number that reframed everything for Marcus. The United States makes up roughly 40% of total global stock market capitalization. That means approximately 60% of investable companies worldwide are located outside our borders. Companies like Toyota, Nestlé, Samsung, LVMH, some of the world's most profitable businesses. If you're 100% in U.S. stocks, you're ignoring 60% of the global opportunity set. That doesn't mean you should flip your portfolio, but it does mean a fully domestic portfolio carries more concentration risk than most investors realize. Now let's be fair. International investing isn't without its challenges. Political risk is real. A change in government, a trade war, or new regulations can tank an entire market overnight. Accounting and disclosure standards outside the US are often less rigorous, meaning less transparency about what you're actually buying. Emerging markets like China or Turkey can be especially volatile, and we've already talked about currency risk. Marcus didn't abandon his US holdings. He simply acknowledged these risks and decided that a blended approach gave him better protection than putting all his eggs in one geographic basket. So what did Marcus actually do? He restructured his portfolio gradually. He kept the majority, about 60%, in a broad U.S. total market fund. Then he added an international developed markets fund at around 25% and a small slice of an emerging markets fund at about 10%. This is similar to what many financial experts recommend as a globally diversified core portfolio. He didn't try to time which region would outperform. He simply owned all of them, and he committed to rebalancing once a year to keep those percentages on track. This is for educational purposes only. Always consult a financial advisor for your specific situation. This final chart shows why Marcus's blended approach made sense, not just for returns, but for risk. Over long periods, a globally diversified portfolio has historically produced returns close to a US-only portfolio, but with lower volatility, meaning smoother, less stressful ride. The drawdowns during crashes like 2008 and 2022 were often shallower when international exposure was included. All investments carry risk, and past performance doesn't guarantee future results. But the data consistently supports the idea that diversification is the closest thing to a free lunch in investing. Marcus didn't overhaul his portfolio overnight. He made gradual changes over 6 months, dollar-cost averaging into international funds alongside his existing U.S. holdings. Today, his portfolio is more resilient, better diversified, and he's no longer sweating every headline about the U.S. economy. The lesson isn't that international is better than domestic. It's that no single market wins forever. The smartest investors own the world. They don't try to predict which country will lead next decade. They simply make sure they're invested wherever growth happens. Like and subscribe to US Wealth Logic for more strategies like this every week. Everything in this video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. Past performance